Welcome to the Opening Bell Report.
You know, whenever we talk about the AI gold rush, it feels like we always end up drawing the same map. You've got the miners, which is basically just NVIDIA at this point. And then you've got the prospectors, Microsoft, OpenAI, Amazon, the ones, staking the claims.
The ones spending billions to dig the holes.
Exactly. And usually that's where the conversation just stops. But today, I want to look at a completely different part of the map.
Okay.
I want to talk about the toll booth, or if you want a less glamorous metaphor, the plumbing. Because there is a specific piece of infrastructure that is currently, broken in the AI stack, and the company fixing it is putting up numbers that, quite frankly, don't look real.
It's the classic picks and shovels story, but we're going a layer deeper. We're talking about the geology of the data center itself.
We are doing a deep dive today into Credo Technology Group, ticker symbol CRDO. Now look, before you tune out, because you haven't heard the name, we are looking at a specific stock analysis report today that paints a pretty wild picture.
It really does.
We're talking about a company that just shattered revenue expectations, is posting 272% year-over-year growth, and is being described by analysts as an AI tax.
That phrase AI tax is doing a lot of heavy lifting in this report. It's a powerful concept. It implies inevitability. That suggests that if you are Microsoft and you want your new billion-dollar server farm to actually turn on, you don't have a choice. You have to write a check to Credo.
So that's the mission today. We need to unpack this analysis report to figure out three things. First, what exactly is this plumbing problem that threatens to derail AI?
Right.
Second, how on earth is this company growing revenue at 272%, which just sounds like a typo? And third, does this gap and go breakout suggest this is just the beginning?
It's really a case study in bottlenecks and how much money you can make if you're the one clearing the jam.
Okay, let's start with section 1 of our outline, the problem. The report calls Credo the plumbing of the AI revolution. But I want to be specific here. When we say plumbing, what are we actually talking about? Because my home Wi-Fi works fine. What is breaking at the data center level?
You have to look at the scale. I mean, we aren't talking about a server room in an office building anymore. The report highlights that hyperscalers, so your Amazon, Microsoft, Meta, are scaling to clusters of 100,000 GPUs or more.
100,000 GPUs. That is just a staggering amount of compute power.
It is. But here is the catch found in the source material. Physics is getting in the way. For decades, the industry relied on passive copper cabling.
Okay.
It's essentially just a wire. It's cheap, it's reliable, and it's been the standard forever. But when you start moving data at the speeds required by modern AI, we're talking 800 gigabits, 1.6 terabits per second, passive copper just hits a wall.
What kind of wall? Is it just too slow?
It's a signal integrity wall. Think of it this way. As the speed of the data goes up, the signal degrades over distance much, much faster. The data literally fades away before it reaches the other end of the cable. It just turns into noise.
So if I'm Microsoft building a cluster, why can't I just use shorter cables? Or, I don't know, thicker cables to carry the signal better?
You can try, but thick cables are heavy. They're physically bulky. If you fill a server rack with thick copper cables, you block the airflow.
Oh, right. Cool.
You literally suffocate the servers and they overheat. And short cables limit how you can arrange the racks physically. So you have a crisis.
A crisis of physics.
Exactly. You have these GPUs, let's call them Ferraris, capable of doing 200 miles an hour. But if you connect them with old passive copper, you're driving that Ferrari on a dirt road full of potholes.
So the GPU is just sitting there idle, waiting for the data to arrive.
Correct. And an idle $30,000 GPU is a disaster for the balance sheet. This creates what the report calls a bandwidth bottleneck.
Okay, so copper is dead. Or at least dumb copper is dead.
Passive copper is dying at these speeds. And that is where Credo enters the picture with the solution highlighted in the report. AECs. Active electrical cables.
Active being the operative word there.
Correct. A passive cable is just wire and plastic. An active electrical cable has a microchip built directly into the connector at each end of the cable.
Wait, there's a chip inside the cable itself?
Yes. It uses something called CRDO and DST technology.
All right, hold on. We promised no unexplained jargon. You need to break down CRDO and DSP for us.
Fair enough. CRDO stands for serializer deserializer. Think of it as a high-speed translator.
Okay.
It takes parallel data, turns it into a super fast serial stream to shoot it down the wire, and then reassembles it, deserializes it on the other side.
And the DSP.
Digital signal processor.
Yeah.
Imagine you're at a loud party trying to listen to a whisper. The DSP is like high-end noise-canceling headphones. It cleans up the signal, removing the interference and noise, so the data arrives perfectly clean.
So Credo isn't just selling wire. They're selling a smart cable that boosts and cleans the signal so it can survive the trip.
Precisely. They're paving the road. They provide the only asphalt capable of handling cars moving at light speed. And the source material is very blunt about this. As clusters grow to 100,000 GPUs, This isn't an optional upgrade. Passive copper simply cannot do the physics. Credo's AECs become the essential fix.
Which explains why the analysts are calling it a tax. You can't avoid it. But let's see if that narrative holds up in the numbers. I want to move to section 2, the hypergrowth explosion.
Right.
Because frankly, when I saw the financial section of this report, I thought there was a typo.
It is rare to see numbers like this outside of a viral software app. For a hardware company, I mean, someone who has to actually manufacture physical things, it's almost unheard of.
Let's look at the catalyst. The stock recently jumped 9% in a single day to close around $134.72. But the trigger was the preliminary Q3 FY26 data.
Right. This is the guidance versus reality check.
They told Wall Street to expect about $340 million in revenue, which, by the way, was already a healthy number. But the actual number came in at approximately $406 million.
That is a massive beat. In corporate finance, you usually manage expectations so you can beat by maybe 2 or 3%.
Yeah.
Beating by nearly 20% on the top line suggests that demand is accelerating faster than even the management team could track. They literally couldn't count the money fast enough.
And if we look backward at Q2 FY26, the revenue was $268 million. The report points out that this represents a 272% increase year over year.
272%.
That's nearly tripling. But usually, and I'm sure you've seen this, when a company grows that fast, there's a catch.
Oh, yeah.
They are usually burning cash to buy that growth. They're spending wildly on marketing or selling dollar bills for 90 cents just to get the user count up.
That's the standard growth at all costs model.
Yeah.
Silicon Valley is famous for it. But Credo is defying that. The report highlights a profitability inflection.
They flipped to profit.
They did. They went from operating at a loss, which is normal for this stage, to an operating income of roughly $78.8 million.
So they aren't just selling more cables, they are making actual money on them.
And that changes everything for an investor. This implies a run rate that is effectively tripling year over year while expanding margins. The source material calls this the moment the business model proves it can scale. It's not just hype. The cash is actually landing in the bank account.
But this leads us directly to the objection I know the listener is shouting at their device right now. The valuation, section 3 of our outline, the AI tax and valuation.
A sticker shock.
It's a big sticker. I'm looking at the PE ratio price to earnings in the report. It is 117.71.
Which on the surface is just nosebleed territory. The S&P 500 average is usually around, 20 or 25.
Right.
Paying 117 times earnings usually means you're buying a bubble that's about to pop.
So why isn't the report screaming sell? Why are analysts bullish on a stock that costs 117 times its earnings? Are they just ignoring the price?
No, they're looking at the speed. PE is a static number. It looks at today, doesn't account for velocity. The deep dive analysis section introduces the PEG ratio, price earnings to growth.
Walk us through how that changes the math.
You take that high PE of 117, but you divide it by the growth rate. Since Credo's earnings growth is effectively over 1,000% because they flipped from a loss to a huge profit, the denominator is massive.
So relative to its speed, it's cheap.
Relative to its velocity, the stock is arguably undervalued. If you're driving a car that's accelerating from 0 to 60 in 1 second, you pay a premium for that engine.
Right.
You don't compare its price to a Honda Civic.
The report also has a comparison table that I found really illuminating. It compares Credo to Astera Labs, ticker ALAB, and Marvell.
This is the market inefficiency argument.
Right. Astera Labs is a darling of the industry. Yeah. Great company, growing at 104% year over year.
Which is fantastic growth. I mean, any CEO would kill for 104%.
But Credo is growing at 272%. That is 2.5 times faster than Astera.
Okay, follow the logic here.
But Credo trades at a lower multiple. Credo is at 117x earnings, while Astera is trading at 153x earnings.
That creates a disconnect. The market is paying more for Astera's slower growth than it is for Credo's hypergrowth.
Why? Is the market just wrong?
Markets are inefficient in the short term. The report suggests that Credo is cheaper despite better execution because the market hasn't fully digested the AEC dominance. They haven't realized yet that Credo is winning the connectivity war. They still think of it as just another component supplier.
So if you believe the report, you are getting the Ferrari for the price of maybe a Porsche, but you're getting a discount on performance.
Exactly. And this circles back to the AI tax concept. If Credo really is the toll booth, if every Blackwell rack from NVIDIA needs these cables, then that revenue is much safer than a typical tech stock.
It's mandatory spend. Microsoft can cut their marketing budget. They can't cut the cables that make the servers run.
Correct. It gives Credo pricing power and volume certainty that most companies simply don't have. They aren't begging for orders, they are taking orders.
Speaking of safety, I want to talk about the balance sheet, because usually 272% growth and hardware company makes me nervous. I picture a company loaded with debt, building massive factories, living on the edge of bankruptcy if one order gets canceled.
Right. Hardware is capital intensive. You need inventory. You need raw materials. It's not like software where you just copy and paste code.
But Section 4 of our outline is titled The Fortress Balance Sheet. The report calls this the silent killer of bears.
I love that phrasing. If you're a bear, if you are betting against this stock, your thesis is usually that they will run out of cash. You're betting they'll trip over their own shoelaces.
So let's look at the vault. What do they have?
Well, first look at the flow. In 2023 and 2024, Credo was burning cash. That fits the risky startup profile.
Right.
But look at the trailing 12 months. TTM, operating cash flow, has surged to approximately $242 million.
That is a massive turnaround.
It's a pivot point. The report notes that their cash flow is approaching 20-25% of sales. That is a financial profile usually reserved for mature, optimized giants like Marvell or Broadcom. Credo achieved this margin efficiency in just a few quarters.
And the total cash on hand.
Approximately $814 million.
And debt.
Negligible. About $16 million.
So they have nearly $1 billion in the bank and basically zero credit card debt.
That's why it's a fortress. This effectively de-risks the investment. They don't need to go to a bank with high interest rates to fund their growth. They can self-fund. For a shareholder, that means no dilution. They aren't going to issue new stock just to keep the lights on.
Okay, so we've got the problem, which is copper is failing. The solution, smart AEC cables, the growth, 272%. The valuation, which is cheaper than peers. And the safety, cash rich. It sounds almost too good to be true.
It does.
What is Wall Street saying? Is anyone betting against this?
Section 5, forecast and sentiment. And the short answer is no. Wall Street is chasing the stock.
The report cites a 91% buy rating, 0% sell.
Which is a very strong consensus. Usually when a stock runs up this fast, remember it's up massively, you get some analysts saying, okay, take your profits, it's overvalued. But here, the consensus is shifting to strong buy.
And the price targets are moving aggressively.
Needham is moving to the $220 plus range. Barclays has a high target of $260.
And with the stock currently around $135, that implies a nearly 100% upside from here.
Yes. And technically, the chart is supporting that view. The report mentions a specific setup called a gap and go.
Explain that term for the listeners who aren't day traders. What is a gap and go?
So a gap is when a stock opens significantly higher than it closed the day before, usually on news, like earnings. Amateur traders often expect the stock to fill the gap, meaning it drops back down to the old price to test it.
But a gap and go
means it gaps up and just keeps going. It doesn't look back. This indicates institutional buying. Big mutual funds, hedge funds, they aren't waiting for a pullback. They are buying at the new price because they think it's going higher. They are sweeping the board.
The report says the stock is in price discovery mode.
Which is a fancy way of saying blue sky.
Yeah.
There is no historical resistance. There are no angry investors from 5 years ago waiting to sell at $150 to break even because the stock has never been there. Above $142, the report says the sky is clear.
And underneath all this price action is what the report calls the flywheel effect.
This is the conclusion of the source material. When you have tripling revenue plus expanding margins, gross margins are around 65%, it creates a flywheel on earnings. Every extra dollar of sales drops more and more profit to the bottom line. It's an efficiency loop.
So let's zoom out. We've thrown a lot of numbers at the listener. $406 million in revenue, 272% growth, the whole AI tax idea. If you had to distill this into a single narrative for someone watching the AI space, what is it?
I would say this. We are in the middle of an infrastructure build-out unlike anything we've seen in history. Everyone is obsessed with the brains, the GPUs, the NVIDIAs, but the brains are useless without a nervous system.
Credo is the nervous system.
Exactly. The narrative is that Credo has solved the physical bandwidth bottleneck that threatens to stall the AI rollout. Because they solved it, and because the hyperscalers need that solution, they're growing at 272%.
And despite looking expensive on a PE basis,
The speed of that growth actually makes them cheap relative to their peers, like Astro Labs.
And why should the listener care? Let's say they don't buy individual stocks. Why does this matter to them?
Because Credo is a leading indicator. Understanding the demand for these cables helps you understand the pace of AI. The fact that Microsoft and Amazon are buying these cables as fast as Credo can make them tells you that they are terrified of their data centers slowing down.
It's a signal that the AI race is actually accelerating.
Correct. If the AI bubble were popping, or if demand was slowing, Credo would be the first to feel it. Instead, they are beating estimates by 20%. That tells you the boom is still in the early innings.
That's a powerful takeaway. It validates the whole thesis.
It does.
So here's where we leave you today. We talked about the AI tax, the idea that you have to pay Credo to play the game. It makes me wonder, and this is something for you to think about, everyone is trying to pick the winner in the software space. Will it be ChatGPT? Will it be Gemini? Will it be some startup we haven't heard of?
That feels like gambling.
But if every single one of those supercomputers requires these cables to function, Is betting on the infrastructure actually safer than betting on the racers? Is the only guaranteed winner the one building the track?
That is the multi-billion-dollar question.
Something to mull over. Thanks for diving deep with us today on Credo Technology Group. We'll catch you on the next one.
Don't forget to like, share, and subscribe for more.